Hello, everyone, and welcome to another edition of the Forex Technical Market Update for August 17th, 2015. Yes, we have already gone through half of August and we are now in the second half of the month. Yes, time flies. But what we have seen over the last couple of trading sessions is a euro that is pretty much stagnant. Now, what I like to do at the beginning of the week is just take a look at the markets for how they are without any trend lines, without any channels or without any chart patterns, and just look to see what is happening in the market and looking across the different markets, just looking what the prices are doing. Because remember, the prices are the most important thing when it comes to trading. The prices will give you clues as to where the market is going, and it's from the prices we can see trends in the markets and market opportunities. Okay, so taking a look at the euro currency, we see that the market is still in a consolidation pattern. Even without the guidelines of trend lines, we can see that this market is in a consolidation pattern. And this consolidation pattern has lasted a couple of months. And one thing when it comes to trading, you have to be, I've been saying this over the last couple of weeks, you have to be patient. An impatient trader is a trader that will take some rash decisions and not follow their trading plan, not follow their trading system, and start to lose money in the markets. And just remember, if you are losing money in the market, someone else is making the money. So if you let your emotions get the best of you, if you become too impatient and start to make decisions that are not in accordance with your trading plan or your trading system, and you start to lose money, you're just giving away your money to the market. So patience is something that all good traders need to develop and need to master. So with the euro, we're in a consolidation pattern, trying to weed out the impatient folk, trying to let the impatient folk throw in the towel and give up on their positions. So with the euro, what we're looking for is a break of this consolidation. A close above this 116 area would tell me that this market could be in for a larger retracement. And if we continue down below 105, that will tell me that this trend is continuing. Because remember, the major move in this market was to the downside. Markets sometimes have to either consolidate, gather some steam, take a breath, and then continue to the downside. Or markets more often than not, retrace the move down. So if we have a move down, the market sometimes retraces that move down, and sometimes can retrace. And that's how Fibonacci retracements come in, where the market can retrace. Common retracement levels are 38%, or the market can come up 50%. Market can go up 61%, or 7.786. The markets don't necessarily need to go exactly to that level, but these are the common retracement points, and these are how we can project what may happen in the markets if we do close above this 115 level. Because more likely than not, if we close above 115, 116, the market could be heading to the first retracement level, or the 50% retracement level near this 122 level. This market could also start a new bull run where the market just keeps going up and takes out this 140 high. So anything can happen in the markets. We, as technicians and as folks who study the markets, we look at what could happen and what's most likely to happen. And that's why it's important to analyze the markets and see what is going on. So the market could retrace to one of these levels, or the market could, as I said earlier, could take a breather, because this was a huge move down from 140 down to 105 is a massive move down. That's over 3,500 pips for a currency, and a decline in a currency over 30%. This is what we had here in the euro moving down. So the markets often takes a breather, consolidates before heading back to the downside, or before starting its retracement. Okay, taking a look at the Japanese yen market continues to be in an uptrend. So even though we have sudden moves down in the market, we're still, look at the overall trend in this market, still moving to the upside, still moving to the upside. If we even compress this chart even more, we are still in a broader uptrend on the daily charts. So if you're a position trader, a swing trader, you'll find that you'll get greater traction in a market like this, buying the dips and being along this market, as opposed to trying to catch these very short movements. I mean, folks often trade retracements, but look how shallow these retracements have been. It's best to keep with the long side of the market rather than the short side. British this morning, what we saw was that the market attempted once again to take out this 157 resistance. Let's draw this resistance level. The market traded up to this 157 area. Let's take a look at the 4-hour chart. Market traded up to 157 area. The high that was made on the day was actually 156.88. The other previous high was 156.90. So it was just 2 pips above the highest point, which happened in late July, and the market is now being rejected. So this area again, this 156.80, 157 area again is showing itself to be pretty strong resistance, and we could see a greater move down in the pound. Bear in mind that the weekly pivot point number is down at 155.13. Actually, with this program, I'm not sure if this is the accurate pivot point for the week. Tomorrow I will tell you what exactly the weekly pivot point is for the British pound. But bear in mind, the weekly pivot point will be somewhere above this low, this 154.50 low. So keep that in mind for a possible area of support. Taking a look before we go at the Canadian dollar, the market did dip down into 130 area, but is now again above 131.40 and looking to rally. And just remember, with the Canadian dollar, we're looking to see if the market does close above the high, this very critical resistance level at 130.64. That's what we're looking for in the Canadian market. Okay, so with that said, the markets are in consolidation, and what we are seeing is that after consolidation, markets do tend to move fairly rapidly. So if you would like to position yourself for the move in the market that eventually will occur, you can click the link below this video to get started with the signals. These signals are automatically sent to your brokerage account. And remember, we only the maximum risk per trade with these signals is just 3% of your equity. So it's a very conservative approach to investing and to trading. It's not something where you are going to see wild equity swings. It's just not that type of approach. We take a very measured approach to trading the markets, because we know these markets, yes, can make a lot of profits, but we do have to protect the downside and do have to manage the risk responsibly. Okay, so thank you very much for listening. Click on the link below to find out more information about the signals, and I hope you have a wonderful day. Thanks.